Reports out this morning that President-elect Trump is considering declaring a national economic emergency to justify universal tariffs. That's according to a report out from CNN. Now, an emergency declaration would allow Trump to use the, quote, International Economic Emergency Powers Act, which allows the president to manage imports during a national emergency. Now, President-elect Trump touched on his tariff plan numerous times during a press conference at Mar-a-Lago yesterday.
We'll impose new tariffs so that the products on our stores will once again be stamped with those beautiful words, made in the USA.
Here to discuss the potential economic impacts of these tariffs and also the Fed's plans and what we could expect going forward, we want to bring in Stephanie Roth. She is the chief economist at Wolfe Research. Stephanie, it's great to have you here on set. Let's start with tariffs. How big of a risk do you see that being to economic growth?
Of course, it depends the scope, right? Over the past week, we've had news surprising in both directions, where on Monday it was, the Washington Post telling us that it might be a much more narrow plan, and then today these might be sweeping and also might be soon. So base case is that we don't actually expect tariffs until later this year. Mm-hmm. If we do get anything close to what Trump has proposed, that would be a stagflationary impact on the economy, no question. However, if it's something more like that Washington Post article, which still appears to be credible despite Trump dismissing it to some extent, that would be not such a bad thing. We're estimating that would raise about $20-something billion per year, which is very different from $100 to $200 billion if it was something more sweeping. Mm-hmm. So certainly would be a much different outcome, and we think all scenarios are on the table at this point. And I don't think Trump has necessarily made his mind yet.
Is there anything in the data right now that actually says we're in an economic emergency?
No, this is more about strategic. No, of course not. The data look fine, but we are relying significantly on China in particular, but a lot of countries for key strategic goods. So the things that was mentioned in the Washington Post are legitimate issues in terms of our reliance on things like medical equipment, things like rare earth minerals. So if we were actually able to raise tariffs and boost production, that would make the U.S. a much more stronger economy. So yes, it's not necessarily a national emergency in the near term, but when we're thinking strategically, this is important for the economy to be a lot more independent.
Stephanie, let's talk about what is being priced into the market right now, because we have investors pricing in 2 rate cuts this year, many expecting that we might actually not even see that first rate cut until July. Is there something within potential weakness that we could see within the jobs market that could move up that timeline?
Yeah, I mean,
how likely?
Yeah, so our base case is the trend in payrolls is closer to 140,000. So that's soft, but still quite good. So if we were to see a trend like that, and then the unemployment rate edge up, certainly we're looking for a 4.3 this print, and it could, if it edges up towards 4.4, that would be a reason to just continue to cut, certainly more than what the market is anticipating. So we wouldn't have to see some significant weakness, but it would have to be notably weaker than what we see today. Our base case is we're looking for 2 cuts this year, so we're not expecting that weakness to materialize in a big way. But if it were to play out, that's kind of what we would anticipate to see.
What's the calculus for if we were to see more than 2 cuts or even less than 2 cuts on the other side of that?
Yeah, so for more than 2 cuts, it would be on the employment side. It would be the unemployment rate rising notably above 4.3. If we were to see less cuts than that, then it would be probably on the inflation side. It's more on about the inflation than employment, where you would start to see, certainly no cuts this year. So that would be something where core PCE is running closer to 2.5% sustainably for much of this year.
And is 2% a target that you think the Fed should stick by in its inflationary goal?
Yeah, I mean, they can't change the goalpost in the middle of the game, right? At this point, it would de-anchor inflation expectations. We've been saying this for quite some time. So at this point, they're stuck with their 2% target. Could they tolerate something like 2.3? Sure. Could they tolerate 2.5? Maybe. But then once you start getting higher than 2.5, that becomes a real problem. The Fed is going to have to change their stance notably.
Stephanie, great to see you here. Happy New Year to you. Thanks for joining us in studio.
Thanks for having me.
Absolutely.